Welcome, everyone. This is a research and data-driven webinar on how Jerome Powell, that's the guy on the screen, and his merry band of Fed governors are affecting everything in the economy and everything in real estate with these aggressive rate increases. Today, you're going to learn that the Fed is gut punching the US economy and why that is the right thing to do. And this gut punch, it affects everything: prices and sales volume, single family, multifamily, cap rates, mortgage rates, inflation, everything in the economy. So this webinar is going to touch all of these aspects. And throughout the webinar, I'm going to present data from dozens of different sources about how the interest rates and inflations are affecting real estate every day, every single day. And in the end, I'm going to stick my neck out and make 12-month predictions on lots of things: prices, rates. And I'm going to point out all the areas where I disagree with the experts. So I really obsess over these predictions because so many of you smart Alex are going to screenshot that last slide and throw it in my face a year from now. But thanks for doing that, because it makes me a much more careful forecaster. So for those of you who still don't know me, I am a quirky and opinionated data scientist and technologist who buys and builds large projects, so multifamily, student housing, industrial, self-storage. These are some of my favorite watering holes. Our portfolio of 30 properties in 10 states is worth nearly $1 billion. But that's my day job. What I like doing the most is to teach, to explode myths, and that's what I'm going to do today. So I hope you have as much fun with this as I'm going to have. So bring on those snarky remarks. This is not a sarcasm-free zone, so have at it. The funniest comments will get a special shout out at the end from Anna and me. So get ready to share your opinions. All right, so why am I qualified to do a webinar on interest rates? Well, this is a sampling of my portfolio, about $400 million. And I worry about the impact of interest rates on the cash flow, the sales price of these projects every day. Every day I think about how to minimize that impact. And I think that's qualification enough. Now, on the left in green are past and present multifamily value adds. We've been exiting them at 20 to 40% annualized returns. And our first two 50% annualized return exits happened this year, with a third exit, Blockbuster, happening next week on the 6th of June. Now, in orange on the top right are new construction apartment complexes that we are building or have built. All four of the ones shown here have already been delivered and been leased up or are delivering right now. So the grid has 17% cash flow, and Coyote Creek is around 8% and growing fast. Now in blue are the diversification projects that our investors wanted: self-storage and industrial warehouses. The self-storage project is actually going to exit around July 15th at over 50% annualized returns, because it's our second super value add project. So Grow Capitus invented super value add. This is where we buy an existing building and then we build more units through new construction, making the property larger. The other half of our portfolio is in a new asset class called build to rent. So if you don't know build to rent today, it's the same as not knowing Bitcoin in 2010. Simply put, BTR is the new Class A apartment complex, and it's the largest, most powerful, most profitable opportunity that exists in real estate today. The second one from left in the top row, that's Botanica Oak Hills, is delivering in the coming months. So I'm going to go tomorrow to San Antonio, 5 o'clock tomorrow morning, to check out the progress. So super excited. By the way, the projects in the bottom row are in the top row are our older built-to-rent projects. The bottom row, these are bigger, more powerful projects that we've been dreaming about them for years. And finally, we get to build them. So all 6 of those are in some stage of construction with a completion value of over $400 million. Here's our track record. As you can see, over 7 exits, we've delivered more than double the returns that we projected to investors years ago. In a rising market, anyone can do this on a few projects, but on 7, that's tough. And so our team of nearly 30 employees works really hard to get these results. And track record's critical, but what's more important to us is that our 800 investors like us. They like our work. For example, Sarah, she's invested in 8 deals. She's had 3 terrific exits. She's also invested in new construction projects that are now expected to outperform. So she talks about how we outperform other syndicates and how we look for better ways to do things. Take a look. And Chong is an investor in 10 projects with us. Here she talks about an exit where we went the extra mile by building an additional 29 unit building to juice the returns. Take a look. All right, done with the Grow Capitis intro and the obligatory rah-rah thump my chest section. Content time. But before we get to the content, here's the really boring stuff that my lawyer forces on you. This is an educational webinar. It doesn't squeeze out the risk in real estate investing. My recommendations are not magic. They're personal opinions. Do your own due diligence, consult professionals, and understand that even if you do all of those things, you could still lose money. Bottom line, real estate and stocks are at-risk investments. Oh, and feel free to type in your questions. I'm going to take them at the end, and we'll be sending out a recording of this event sometime tomorrow. All right, look at that. My design team really knows how to get their message across, right? 8.5% in a country where average inflation has been under 2%. I filled gas in my car yesterday, and a $100 bill didn't fill up my 16-gallon tank. Section 1 of this presentation talks about runaway inflation, interest rates, and the Fed's dangerous gambit. So get ready for some powerful data. Now let's start this journey by looking at mortgage rates first. Let's start with this CNBC video from about 2 weeks ago. Now, before I play the video, remember, the Federal Reserve doesn't set mortgage rates. They only influence them.
Hey, Morgan. Yeah, rates took a sizable jump higher at the end of last week, basically adding insult to injury in the heart of the spring market. The average on the 30-year fixed hit 5.64% on Friday. That's just over 2.5 full percentage points higher than a year ago, as in we were in the very low 3% range last year. Mortgage rates loosely follow the yield on the 10-year Treasury, which spiked to over 3%. But rates are also taking a hit from the Fed unloading its balance sheet of mortgage-backed bonds. It was the Fed's increased purchasing of those bonds during the first 2 years of the pandemic that kept rates hitting more than a dozen record low. And those low rates fueled the crazy high home prices that we now have this spring. Home prices are 34% higher than the start of the pandemic, and they just keep moving up due to high demand and still low supply. So if the 30-year fixed hits 5.75%, which it very well could this week, that'll mean the monthly mortgage payment for the average home is $1,867 higher than it was at the start of the pandemic, $1,867. That's if you're putting 20% down. It would be over $2,000 more a month if you can only put 10% down, which is a lot of first-time buyers using FHA mortgages, and they, of course, have the least wiggle room in their wallets. We're now seeing sales fall, and reports anecdotally that bidding wars are starting to cool off. Prices usually lag sales by about 6 months, so this summer should be pretty telling on home prices, Morgan.
So let's quickly summarize that video, right? There's a lot in there. Mortgage rates in May are up to about 5.64% for 30-year fixed. Last week, by the way, they dropped a little bit, but still almost at 5.5%. This means that they're more than 2.5% higher than 1 year ago. And we also saw that home prices are 34% higher than before the start of the pandemic. And this means that the average monthly payment is over $1,800 a month higher than at the start of the pandemic. Are you kidding me? $1,800 a month? That's $22,000 a year. What regular Joe American got a $22,000 raise in 2 years? Nobody. So that's the good news. But I want to point out that the media loves to pick up the highest number to get more eyeballs. That 5.64% number is not representative of the people that are watching this webinar right now. So I send my team out to shop rates on the internet. This is about 2 weeks ago, right? And I know my investors can put 20% down. You know, you guys have strong credit scores when you're buying single family homes. So while 5.64% may be the average mortgage rate, note that that buyers that have higher credit scores and higher payments than a typical buyer, so you see these up here, right, will get significantly lower rates. So this data is from bankrate.com. As you can see, the rates that are shown in this gray shaded section are actually in the 4.5 to 4.75 range for those with 20% down and 740 credit. Now, these numbers are for primary homes, not for investment homes. But what this means is that people with lower down payments and lower credit scores, basically the first-time buyer, are actually going to hurt a lot more than richer investors with more buying power who are still getting rates well under 5%. Bad news for the common man, less bad news for the affluent investors. You'll never hear, TV channels say stuff like that. So if you put 20% or 25% payment, you'll get a better deal. But still, it's clear that mortgage rates are skyrocketing, right? I mean, 2.5% increase in 6 months is a stunning increase. So let's spend a few minutes to understand why rates are skyrocketing. Well, in short, they're going up because the Federal Reserve has announced that they're going to fight inflation by raising the Fed funds rate. Let's look at where inflation is at the end of April, 8.3%. And as you can see from the red line, this red line in this graph, inflation in the US tends to average just a little bit under 2%. And the Fed's job, the Federal Reserve's job, is to keep it at that number. 2% inflation allows the US to keep overspending and running up deficits because inflation, it's a hidden tax. It reduces the value of money. So inflation is good for spenders, bad for savers. However, high inflation is good for absolutely nobody. It's bad for consumers, it's bad for businesses, bad for retirees, even bad for real estate eventually. And as you can see from the chart above, inflation is far, far above the 2% line. Now, it's wrong to look at inflation statistics without acknowledging that the official measure of inflation, the Consumer Price Index or CPI, it's inherently flawed, people. The numbers may be cooked, right? The CPI is used to adjust Social Security payments for retirees, and there have been accusations for decades that the CPI is manipulated to show inflation to be lower than it is. So it's also useful to look at an unofficial index called shadow stats, which might show a more complete picture. As you can see from the blue line above, real inflation could be as high as 12%, while the official line in red is around 8%. So bottom line, inflation is truly, truly extremely high, and the Federal Reserve has no choice but to take aggressive action to reduce inflation. Let me say this again. The Fed has no choice. Now, the Fed can control inflation by raising and lowering an internal rate called the Fed funds rate. This rate, which is a rate that banks charge each other for the excess reserves, it has a direct impact on mortgage rates, though mortgage rates can be often out of sync with the Fed fund rates for many, many months. In general, the Federal Reserve raises rates when inflation is high and the economy is overheating, and then drops them when the economy is weak. Right? For example, if you look carefully at the chart, you'll see that the Fed raised interest rates 9 times between 2015 and 2018. And by doing that, it slowed the economy, cooled it down, and was then forced to back off and drop the rate 3 times in 2019. What I'm pointing out is that this rate raising business, it's more art than science. The Fed raises rates, then waits for a while, studies the economy, then drops them, waits for a while, rinse, repeat. It basically plays Russian roulette with the US economy. And as you can see from this comment in The Guardian, the Fed is now expected to raise rates a total of 7 times this year. Now, they're already done with 2 hikes. So 5 more hikes coming, which should take the Fed funds rate from 0.25 when they started earlier this year to about this, 2.9%. And what is the Fed's goal? To engineer a soft landing. Soft landing. So more about that in a few slides. Okay. So the Fed has hiked twice so far this year, a total of 0.75%. But you just heard from the CNBC commentator that mortgage rates are up by over 2%. So that's weird. Aren't these 2 rates tied to each other? Yes, but very, very loosely. What's happening is the market is anticipating what the Fed will do and has raised their rates by 2.5%. Well, this number's wrong here. It should say 2.6%, not 1.6. So basically, these dudes, they're running almost 7 or 8 hikes ahead of the Fed. This is very important to understand. The market's already up 2.5% from the bottom, and the Fed's only up 0.75%. So the Fed actually has to catch up to the mortgage market. Yes, but Neal, what happens when the Fed hits the 2.9% level that economist was talking about a few slides ago? Well, here's the answer. This is so important. Listen carefully. The answer is when the Fed reaches that level, they will start cutting rates. Yes, cutting rates. Look at this chart, right? The Fed controls inflation literally by gut punching the US economy. They taser us, right? And the country can't take the shock of these high interest rates for more than a few months. Look at this chart, and you'll see across the chart 9 hiking cycles. All these 9 peaks on the screen are extremely short. In fact, these peaks don't even last more than a few months, given how addicted the economy is to financial cocaine, that's ultra low rates, and financial meth, that's ultra low liquidity. Why would you expect this time to be any different? The patient, us, the US economy is going to die if it doesn't go back on the drug drip. The Fed knows that. The rates are likely to peak by the end of this year or the beginning of next year. And then inflation will hopefully moderate to, let's say, 3 or 3.5%. And then rates will fall, just like they have 9 times out of 9 in the last 61 years, because the Fed is simply trying to engineer a soft landing. And as you can see from the Investopedia definition, a soft landing is the Fed's goal to slow the economy down without it going into a severe downturn or a recession. Choke the air from the lungs so the patient stops running around, and then resuscitate the patient before he dies. This highly technical diagram on the left accurately describes what the Fed is now doing. So of course, a data-driven audience like this wants to know, Neal, how often has the Fed really soft landed the plane? Well, as you can see from this quote on the left, this is from Politico, the Fed sucks, absolutely sucks at creating soft landings. In the last 61 years, the Fed has tried to engineer soft landings a total of 9 times. Now, how many times did it succeed? Once, one time in 1994. Not the best track record. Why? Well, that's because it takes many, many months for interest rate hikes to actually affect and slow the economy. So the Fed has to make educated guesses about the impact. In other words, the Fed cannot aim, fire, measure. It's more like aim, fire half a dozen times, then measure once. So here's another highly technical document that very accurately describes what the Fed tries to do when it hikes rates. My team, by the way, loves these cartoons. Clearly, they're getting very carried away by this stuff, Anna. All right, so that technical document explains the problem, and it explains why the stock market is slowing down, crashing, goes up, went up this week, but last week it was gloom and doom. Investors, they feel that the Fed's job is much harder this time than most of those last 9 times because inflation is so severe this time. And so they have very, very little trust in the Fed's ability to prevent a recession. And the market, it's really addicted to ultra low interest rates and this high liquidity punch bowl. And the Fed's taken that punch bowl away. By the way, in case you're wondering, REITs or real estate investment trusts also down about the same as the S&P 500, about 18%. Okay, so the Fed doesn't have a great track record. Wall Street doesn't trust the Fed. But to be fair to the Fed, they might have a pretty decent chance of actually achieving a soft landing this time, because this Fed has one unique weapon. The Fed is tightening in an economy that is drowning in money, in cash. Americans have absolutely fantastic household savings. As you can see from this graphic above, the total value on the left here of America's savings, and this is both savings and money market accounts, this was about 12 trillion 10 years ago, so in 2011. Today, that $12 trillion number is sitting pretty at over 22 trillion. In fact, a staggering 5.8 trillion has been added to savings account just in the last 2 years. That was all that helicopter money that the government sent out, right? So this is incredibly good news for the Fed, because this $6 trillion buffer means that consumers are continuing to spend even as inflation goes up. They have a lot of money. And this gives the Fed a better chance of engineering that soft landing. Ta-da! Household balance sheets to the rescue. All right. Now that I've finished my Fed bashing, I do want to point something out. 5.5% may seem very high, very high. Please note, though, that people were buying homes at 18% interest rates in 1982. Look at this graph. And you see, I'm going to move the mouse. You see this gray area here in 1982, right? As you can imagine, this gray area is a recession. So it was caused by this peak, right? The Fed raised interest rates to 18, and they immediately caused a recession, right? They were trying to kill inflation. Now, I wonder what happened to home prices when the Fed raised interest rates to 18%. Now, just to compare, we are predicting that the Fed funds rate will go up to less than 3% at peak. This is 18, right? So you might think that home prices would have crashed and burned, right? I mean, who would be stupid enough to buy a home with 18% interest, right? Wrong. when the Fed went to 18%, home prices went down by 10% the next quarter, bounced back by 10% the following quarter, and actually ended up higher at the end of the recession than at the beginning. Americans, we love buying homes. We're not easily deterred. And that was one example. Let's take a look at another example on this page. So, between 2001, 2007, rates stayed between 5 and 7.5%, and we still had a strong housing economy. So while 5.5% today seems high, it's really nothing special at all. I also like to show this graph to you guys. Like, this isn't updated to 2022, but what I want to point out is that mortgage rate trend in the US declined for 150 years. Then they went upwards until they peaked in 1981. And since then, for 4 decades, they've been moving in a downward trend. And when this short-term mortgage rate spikes ends, and should end fairly quickly, I don't expect that downward trend to change. Why? Because it's all tied back to macroeconomics and increasing world debt, which, by the way, is covered in my How Banking Changed the World webinar, which is available on our website, multifamilyu.com. So if you want, maybe Anna if you can find a direct link and stick that in chat for those that basically want to understand why the heck it is that interest rates only go down in the long run. All right, done with section 1. Let's summarize. Rates are high because the Fed's battling inflation. Data indicates that mortgage rates will peak around the end of the year, as mortgage rates actually anticipate future Fed increases, so they're ahead of the Fed. And while we all hope that the Fed engineers a soft landing, history shows that's going to be unlikely to happen. All right, now that we've set the groundwork, let's go to section 2, where we discuss if the US housing boom is a bubble. Anna, I love this graphic. I mean, isn't this an amazing graphic? House in a bubble?
I love it too.
It's amazing, right?
Yeah.
Now, figuring out if this is a bubble is critical, Anna. I mean, why? Because we are here to try and figure out what's going to happen to real estate in the next year. And what happens depends on whether housing is indeed in a bubble. That drives all of our informed speculation, right? All right, our first data point comes from Fortune magazine and CoreLogic. As you can see above, CoreLogic believes that 65%, 2/3 of US housing markets are overvalued. And every major growth market, Texas, Florida, Arizona, North Carolina, Utah, all overvalued. So 2/3 of the country has overvalued real estate, and 100% of growth markets are overvalued. Are you getting nervous? Well, you shouldn't be. Here is CoreLogic's estimate of price drops. Remember, in the last slide, they were simply talking about the US being overvalued, not about potential price drops. Here you see not much red. Blue is good. Blue is really good, right? CoreLogic estimates that 80% of the US has low or very low chance of price drops. And this is brand new data from May, right? 10% has a medium chance of price drops, mostly here in purple, here in the Northeast, and also in the Pacific Northwest, and also some California, right? All the growth markets, Texas, Florida, Utah, North Carolina, all blue with two exceptions. So Phoenix here and Vegas. Phoenix and Vegas are the only growth markets that are basically at a high risk, right? And then you've got the ultra high risk markets, elevated risk, and basically that's Bend, Oregon, Tacoma, Washington, those sorts of markets, and some up here in the Northwest. Bottom line, I have read a lot of research papers for you. These people all remember 2008, so they're much more cautious. At least I think they are. But there's a very strong consensus that the housing market is not in a bubble. But why is it a bubble? Why is it not a bubble if it's overvalued? Why? Well, all of these studies cite the lack of supply of both single family and apartments. So lack of zoned land, supply chain constraints, rising cost of construction, and a very NIMBY attitude towards apartments. These are the 4 main reasons for this lack of supply on the left. Contrast that with 2007 when there was plenty of supply. Now match up this lack of supply with very strong demand from boomer investors and from millennial homeowners, very, very strong job markets, and it's hard for the bubble to burst if it exists. Also, as we've mentioned before, the massive stimulus from COVID means that both investors and the common man have massive amounts of accumulated savings. So if there's a dip in prices, investors jump in quickly. Incomes are also rising very fast because of inflation. Lastly, the remote work phenomenon means that Americans are spending more on their homes. They want offices, they want more rooms. That's driving up demand, even as rates moderate. So these are big reasons that lead us to the conclusion that the US single family market is overvalued, but it's not a bubble. And I looked at more studies and analysis from various sources, including Forbes and the Wharton Business School, and I couldn't find one analyst that felt that housing was a bubble that could burst. Even bearish analysts like Ivy Zellman, she took pains to clarify that housing is overvalued. It's not a bubble, right? On screen are some of the other consistently cited reasons. First, the baby boomers. I mean, these people are rich. They're leveraging their equity into real estate at massive rates. They're buying SFR rentals and multifamily and single tenant net lease retail properties, and they're using 1031 exchanges to prevent taxes. And then you've got the millennials. They've finally reached their peak home buying years. So from 2019 to 2024, they're going to be buying homes, and that's putting upward pressure on prices. I do expect that by 2025, there's going to be some challenges. All right. To repeat, there are big reasons that lead us to the conclusion that the US single family market is overvalued, but is not in a bubble. What if everybody's wrong and there is a bubble? Wouldn't interest rate hikes be the one thing that pop that bubble because sales are going to tank? Well, the answer is they probably won't because of ARMs. Adjustable rate mortgages are back. In January, only 3% of all single-family loans had an ARM or an adjustable rate. By May, it had tripled to 9%. And currently, the average rates for a 5-year ARM are a full point lower, so only 4.5%. And that allows buyers to continue buying and keep the down payment down. So I wouldn't be surprised to see ARMs become 20 or even 25% of all mortgages in the next 3 months. And I know, ARMs are bad. We didn't learn from 2008, yada, yada, et cetera. But if these ARMs are going to blow up, they're going to blow up 5 years from today. The rates don't adjust for the next 5 years. So I'm not holding my breath. Neither should you. So the US market is probably not a bubble that's going to pop. So what is actually going to happen? Well, instead of sharing information from half a dozen analysts, I'm just throwing up the least bullish guy. Note, everyone else thinks that the single family market will slow down, but keep growing. Prices will keep going up. This dude, he's the only guy that says, nah, not going up. So the most bearish guy says the housing market has peaked. Everything points to a rolling over of the housing market. And honestly, this comment in blue, it looks like gloom and doom, right? But then you jump into his detailed analysis. And what he's really saying is home prices will be flat. You look at these two green bullets. Some markets drop by 5 to 10%. And if there's a recession, then those markets drop by 10 to 20%. Still, he's talking about some markets, not the US. And this is the most bearish analyst that my team could find. So I really hope that they're not all drinking the Kool-Aid again. All right. Done with single family. It's probably not a bubble, just overvalued. What about commercial? You know, multifamily and industrial and retail, all the other asset classes. Well, here's John Chang. He's a personal friend of mine, and he's the National Director of Research at Marcus & Millichap. This is John's 26th year at Marcus & Millichap, so I think he knows a few things. Let's hear from the man. Now, note that John's going to talk about cap rates, but really, you can swap the word bubble in for the cap rates pretty safely. It's going to end up being the same analysis.
Hey, everyone. The top question I'm being asked these days is when or whether cap rates will rise due to increasing interest rates. Many investors think there's a direct correlation between cap rates and interest rates, that borrowing costs will drive investor purchase decisions, and because of that, sellers need to lower prices and raise cap rates on the properties they sell in order to clear the market. While there's some merit to that idea, it doesn't completely hold true. Looking at commercial real estate in general, the spread between the average cap rate and the 10-year treasury has ranged from as high as 582 basis points in 2011 to as low as 214 basis points in 2006. There's simply a lot more going on in commercial real estate than underwriting to a spread over the cost of capital. Here are a few of the other considerations and how they're impacting yields today. First, how much capital is active in the market? Sometimes there's a shortage of capital, like during and immediately after the financial crisis. When there's a shortage of capital, cap rates tend to rise and the yield spread tends to widen. But when there's a lot of capital, both equity and debt, the spreads tend to tighten. We're going through that process right now. Last year, there were a record number of commercial real estate sales. The total number of transactions was up about 30% compared to 2019, which was the strongest prior record. Preliminary estimates of first quarter activity this year suggest the rapid transaction pace has continued, with sales up approximately 20% compared to the first quarter of last year. Basically, when there's a lot of liquidity, investors are willing to take a lower yield because they're competing to invest capital. A second factor is whether there are alternative investments that offer a better yield, maybe the stock market or bonds. Given that the S&P 500 has fallen more than 16% since peaking at the end of 2021, more capital may pursue the stable returns offered by commercial real estate. That in turn increases buy-side pressure, keeping cap rates lower. A third factor is upside potential, either through market momentum and strengthening fundamentals or through investor value add. For example, industrial property absorption has averaged nearly 300 million square feet per year for the last 10 years, and it surged to 550 million square feet last year, driving the vacancy rate to an all-time low and boosting rent growth. Given the exceptional momentum, investors remain aggressive in their industrial acquisitions, keeping pressure on cap rates. Likewise, investors continue to pursue value-add real estate, paying a premium on existing revenues with the intention of raising returns over the next year or two. Finally, we need to consider demographics. As baby boomers retire, they're looking for reliable cash flow, and commercial real estate, especially single-tenant net lease properties, fits that role. Retiring investors leveraging 1031 exchanges are a significant driver in this arena. So even though interest rates have been rising, and many expect that trend to continue, it will not necessarily push cap rates higher. We may see some upward movement, most notably in markets and property types that appreciated fastest in the last year, but a broad-based re-indexing is unlikely.
All right. Commercial, not likely to be a bubble. So there ends our second section. It appears that neither single family nor commercial are in a bubble, just bubbly or bubblish. Yeah, bubblish. I'm going to go with bubblish. So it's time for the crystal ball section. This is where I stick my neck out and you, smart Alex, take screenshots and use them to cut off my neck a year later. One thing about me is I consistently never learn. So here we go again. We will make 7 predictions. 1 year from today, where will single family prices be and multifamily prices and inflation and interest rates and cap rates? And we will wrap up this crystal ball section and this webinar with our prediction on the likelihood of a US recession. But before I fire up the crystal ball, I want to take 2 minutes out from this content to share 2 of our current projects that are very attractive to active and passive investors. The first is a unique project. It's in the Austin market, one of the hottest. We're building a tech-enabled micro-home community. It's located in San Marcos, near Austin. This product is filling a sorely needed gap in an area with a very severe housing crisis. We've raised over $11 million for this project, and so the project is about 90% subscribed. The model has 3 major elements. So it's got a stunning, very efficient, environmentally sensitive design, an incredible tech stack of 14 different technologies, and then a curated lifestyle with engagement opportunities that all the tenants crave. The Casara units are modularly designed and constructed off-site, which is something that's very popular in Europe, rapidly becoming adopted in the US. So faster construction, less waste, higher quality structures, and reduces the timeline and the long-term operational costs. And as most of you know, when it comes to multifamily investing, Austin is the place to be, right? So in the last 10 years, the population of Austin grew by 32%. Remember, the US grows by roughly a fifth of that. But it didn't even keep pace with job growth of 44%. So it's becoming the #1 tech center in the US, beating San Jose, California. It's got the hottest big city labor market. It's contributing to these skyrocketing real estate prices. Rents increased a whopping 35% last year. And it's very expensive to rent in Austin. So residents are looking for more affordable cities such as San Marcos. You know, San Marcos rents are growing just as fast as Austin, but they are about 35% cheaper. And in terms of projected returns, I'll just throw them up on the screen. I think they're very, very strong. Most people will be lucky to get into a project such as this. So more than double a projected return over 5 years. And if you're interested, go to growcapitalist.com/Andrew, and he will walk you through a presentation on Casada Micro Homes. Our second project is Equinox Townhomes in New Braunfels, Texas, on the Austin-San Antonio corridor. Phase 1 of this project was sold out, but we've had a couple of investors who backed out because of the stock market losses. So we do have a couple of units available again. This is 110 townhomes spread over 10 acres right in the middle of the city. There's a retail center directly across the street, and the city is building a very good-looking modern park with amenities right next to us. Vaulted ceiling, large windows, wide rooms. We think this is a dream product for renters and investor buyers. We're projecting 27.9% annualized return. This is 100% ownership of a turnkey product. So it's a BTR, or built to rent product, and it's in a market which is the third fastest growing population in the entire country out of 1,000+ cities. This is an amazing city, amazing population growth, 10x faster than the US, even faster than Austin. Its job growth is also 9.8 times faster. So lots of people are worried about interest rates, so we created the US's first low-cost interest rate protection program. This caps your interest rate so you can invest now without worrying about a future rate increase. So it's only available through us. And you can learn more about this project and our new interest rate protection program by booking a group call with Peggy. The link is on the screen, and I will also paste it in chat for you guys. So check out both of these projects. They're pretty awesome, and they'll be gone pretty fast. All right, let's fire up that crystal ball. Let's give you our informed projections on all of these topics. How many times will the Fed hike? What will interest rates be like, or mortgage rates be like 12 months from now? Will inflation be raging 12 months from now? Or will home prices be higher or lower? Will syndicators be paying more or less for multifamily? Will the US economy be in a recession? And finally, what will multifamily cap rates look like in a year? So our projections on a very bumpy ride to come. All right, my first forecast on Fed hikes. As of today, the market is robust enough, so the Fed will actually do what it's been telling us it will do. They will hike the Fed funds rate from the 0.75% today to what I believe will be about 2.75% by the end of the year. So 8 more quarter point hikes are coming, with 4 of them coming just in the next 2 months. So painful for those of us with bridge loans with floating rates. And I know that there are many of you who think that the economy will weaken so quickly that the Fed will not get to 8 more quarter point hikes. But to those people, I'm going to say this. The only thing worse than drinking Kool-Aid that everything will always go up is smoking hopium that everything will go down. They are going to go through these hikes, and that is my prediction. The Fed is terrified of hyperinflation, and the Democrats are even more terrified of it because of midterm elections. It's going to happen. Let's start with my interest rate forecast. On the left is or in the middle is the single family interest rate or mortgage rate that I'm predicting. This, I think, is going to surprise you because the video at the beginning of the presentation said that single family mortgage rates were at 5.5 already. So 6.25 or lower, that's really gutsy, right? With so many Fed hikes to come? No, not gutsy. Most forecasters would agree with me, right? If you look at the blue bars in the chart, forget the green ones, the blue bars are 30-year fixed. And you take out this first guy, Adamo, and this last guy, Helios, right? These are the outliers. So if you look at it, the consensus is actually around 6%. So my number is actually on the bearish side. Remember, the market's already priced in 7 or 8 of these quarter point hikes. So 6.25 would probably mean 10 or 11 hikes in total. So I think this one's fairly safe. Also, a year from today, the Fed should be dropping rates, and the mortgage market tends to be an early mover. Next up, multifamily interest rates. A lot more complicated. All right, so with multifamily, I predict that 10-year fixed rates will stabilize at around 6% a year from now. But bridge rates, really hard to tell. all I can see is that bridge lenders are kind of like stock market traders. A single piece of bad news makes them bearish. A single piece of good news makes them bullish. So get ready for some volatility in bridge rates for the next 6 months, not a year, but 6 months. We've already had 3 crazy months. And newsflash, it doesn't settle until next year. And a year from now, I can't even guess where bridge rates will be. So I'm just not going to make that prediction. All right, done with rates, on to home prices. My single family prediction is that prices will not drop nationwide. They will go up by 4% in the next 12 months. This is nationwide. But this rise will not be across the board. I do expect that ultra red hot markets such as Tacoma, Boise are going to see price drops 5 to 15%. In fact, I agree with every city on this slide. Redfin and CoreLogic came up with a list of markets that are very likely to see price declines. Luckily, no major cities in the list. Californians might want to note that Sacramento is in the list. Washington State has 3 cities in the list, and the rest are pretty small cities, right? So not huge. So 4% up nationwide, 5 to 15% drops potentially for the cities on this page, plus Boise, which isn't on this page. That's my single family forecast for 12 months from today. Okay, let's move over to multifamily and predict cap rates a year from now. Now, I know there are people in the audience who don't understand cap rates, and even people who do understand cap rates find it difficult to calculate the impact on prices. So I'm going to give you a simple example. Let's say there was a property that was selling in January in that ultra hot Jan market at 4 cap for 30 million bucks. Well, if that very same property was selling now and closing in October at, let's say, 4.5 cap, right? Well, its price would drop a lot from 30 million to 26.3 million, right? So half a cap is a pretty big deal. And it can make the difference between investors making 30% a year here to making 15% a year here. And I'm going to predict that cap rates in the US will rise. I disagree with my friend John Chang, the Marcus and Millichap guy. I disagree with the National Association of Realtors and JLL. All of these people are expecting multifamily rates to stay the same, stay where they are today, plateau. I disagree. I'm going to predict that multifamily cap rates will rise significantly by as much as 0.5% from Q4 2021 or Q1 2022. The previous quarter. These were the 2 peak quarters for the cap rates. When I say mean peak, I mean lowest. Remember, when cap rates go down, prices go up, and vice versa. Now, why am I disagreeing with my fellow forecasters? Well, because while the past is a great predictor, and the past is definitely in favor of all these big guys forecasting a plateau, we've never seen cap rates this low. And I have a different belief. I believe that the lower cap rates go, the more sensitive they become to interest rates. So all-time low rates equal an all-time high sensitivity. Hence, this prediction on the screen of 0.5 cap up. Now, here's the good news, right? Note this comment that's popping up on the right. I believe that multifamily cap rates will only decompress for 3 or at most 4 quarters, and then are likely to start compressing again, because there's this massive hunger for multifamily in the market. So I'm content to hold on to my portfolio for the next 5 quarters. Just sit on it. Okay, now let's look at projection of multifamily prices 12 months from now. But wait a minute, Neal. Didn't you just show us an example with prices going down from 30 million to 26 million and change? So didn't you already answer the question that's at the top of this page? No, I didn't, guys. In the last slide, that was just an example of how higher cap rates affect price. There are actually 2 things that affect multifamily prices. One is cap rates. The other one is net operating income, or NOI. So now let's tweak that example again. On the left was a property selling in January at 4 cap for 30 mil. On the right is the same property now selling next year, a year from now, at a higher cap rate. Remember, I'm forecasting the cap rates will go up, meaning prices will go down. But rents are going up like crazy. So if rents go up 10% in the intervening year, this property, even at this higher cap rate, sells for almost the same price. Not quite, but almost. So my multifamily prediction is down, then back up. I expect that when we compare prices per unit, to Q4 of last year or Q1 of this year, the ultra hot phase, to prices in Q3 or Q4 of this year, the post-hike phase, we will find that prices per door are about 5 to 10% lower, depending on the market. But as rents continue to rise, we should see the situation start to reverse. And 12 months from today, I wouldn't be surprised to see multifamily prices go back to where they are. So down a bit, up a bit, but overall flat if you look out 12 months. Okay, two final predictions left: inflation and US recession. I project that the Fed will beat inflation. Look, they've done this 9 times since 1961, and with one exception, 1982, they've beaten inflation every time. And while inflation was indeed at 8.3% in April, that was the 12-month reading. I actually went to the St. Louis Fed site. I found the month-over-month inflation. It's definitely moderating. Supply chain issues are easing. Lumber prices have crashed to less than half of what they were in January. So I predict that inflation is going to be around 3% a year, 3% 1 year from today. So not quite back to the 2% level that the Fed likes, but well in control, enough for them to stop this gut punching that they're doing. We end the webinar by projecting a US recession within the next 12 months. And here again, I differ from analysts. The current consensus is for a 40% chance of a recession within the next 12 months. I think that this is a recency bias, and that 40% number is going to keep going up as the Fed keeps throwing these rate punches and these liquidity uppercuts. My belief, over an 80% chance of a US recession in 2023. No recession this year. The US economy is too strong. Household balance sheets are too rich. It takes time to cool everything down. And note that I'm not predicting a 2008 type recession. In the chart above, you see 8 gray bars. Now, 2 of these are thicker bars. This one here, and then that one there, right? This is basically 1981, 82. This is 2008. I believe that the recession is going to be a vanilla recession, like this one here. This is a vanilla recession, 6 months long. It's going to be accompanied by the Fed then cutting rates. Note what happens when they raise rates, recession happens, they cut rates. So what will happen again in 2023 is that the Fed will cut rates, they'll increase liquidity. That will start the cycle again. So if you can hold on beyond that 2023 recession, you should be able to refinance at lower rates and also see very strong, fresh demand for real estate assets. And with that positive news about future rate cuts, hopefully a year from now, we end this webinar. We would love to take your questions.
Poll. So while we are, people are typing in their questions, they can also answer a few from us.
Sure. I see a couple here that I can answer very easily.
Go for
Jeff
it.
mentioned, I couldn't find the Multifamily U webinar on banking that Neal mentioned. Can we check to see if we can find it on the website?
Did as well, and I didn't see it either, which is why it's not posted. So
I thought that it was posted. Okay, well, we'll have to figure out, Jeff, we'll have to figure out how to get that out to the people that are here.
I believe it needs to be updated, and then that's why it wasn't there.
Yes. So Jeff also mentioned CoreLogic didn't include Tacoma. The answer is, Jeff, I usually look at several different months. So CoreLogic clearly is very bearish on that entire area. In one month, they included Tacoma, and the other month, they included Olympia, and also another area north of Seattle. So I feel like they're very bearish on that area. Right.
Okay, turning your attention to the Q&A. Let's see. So good question. What happens to the unemployment rate?
Well, usually as the economy slows down, unemployment either stays the same or tends to drop. In a vanilla recession of the 6-month variety, it doesn't tend to drop, it doesn't tend to increase too much. So right now, I think we were at 3.6%. So I'd see it going up to maybe 4.6, maybe 5% if it's a vanilla recession. That's still a lot, right? 1.5% of the US population, still millions of people that will lose their jobs.
All right. And let's see, is everything high due to the fact that it's harder to get commodities? Is food is high, gas is high, homes high? Is that why things are high, Neal?
Not quite. I think that in general, food is high and commodity and oil is high because of the war, right? So they were slightly high before the war, but now they're completely out of control. Remember, the number one wheat producing nation in the world attacked the number five wheat producing nation in the world, completely destroying food supply chains. They haven't come back, right? So, one prediction that I saw, an unfortunate prediction, is that while tens of thousands of people die in the Ukraine, millions are going to die in Africa. All the food, all the wheat for the Africans comes from Ukraine. So in our case, it's not a direct impact on us except to our pocketbook in that food is going to stay up until the war ends. Same thing with oil, right? So obviously the oil market is in a huge adjustment. So I think those are temporary things that will work themselves out over the next 6 months or so. I think the war would end before the end of this year simply because Russia would run out of tanks. So I think that piece of it is temporary. So the answer to your question really is no, there is a long-term trend towards single family and multifamily prices going up, and that has to do with insufficient supply of both apartments and single family homes. That's really the reason why real estate's been going up. Obviously, high inflation is going to drive prices higher, but I don't think that commodities are the primary reason. No.
Well, since you mentioned houses, is the price to build a house increasing, decreasing, or staying stable per your prediction?
Increasing very fast. So in 2020, the builders index showed 4% inflation. So that's right before, 2019, right before COVID. And last year it was at 12%. So, usually construction prices go up about 3, 4, or 5% a year. Last year it was 12. So significant increase.
It was reported that Jamie Dimon said average consumer has about 6 to 8 months in savings left, assuming inflation at this rate. Do you anticipate change in Fed policy at that point?
At some point, yes, but I think that keep in mind when he says you've got 6 to 8 months left, he's not saying that inflation is going to basically completely demolish those, and in 6 to 8 months the consumer will be penniless. That's not what Jamie's saying. Smart guy. What he's saying makes sense. I think Jamie is fairly bearish at this point. He thinks that there's going to be a recession in 2022. I read his post when I was preparing for this webinar. Sort of agree with the guy, but what he's not saying is that the Fed will be forced to back off. That is not my feeling from what Jamie's saying at all. He basically what he thinks is the Fed will put us into a recession. That's why he's bearish on the economy. He doesn't think that the Fed will back off. I don't think that the Fed will back off. Remember, hyperinflation is a far more dangerous creature than a recession. I would take recessions over hyperinflation any day. The US has never faced hyperinflation. I come from India, and in parts of India have faced hyperinflation. You would pick a recession over that any day, my friend.
This is related to Phoenix. Is the risk of housing price lowering high, even for multifamily in Phoenix? So in other words, is multifamily also going to face lowering in price in Phoenix?
Yes, I think so. I think that Phoenix prices for multifamily would follow the same prediction that I made, which is, they're going to go down. In my case, I think for Phoenix might go down 10%, not 5%, and then works its way back up. So Phoenix prices may not be back up to their per door price that was in January, the ultra hot phase. Maybe by next year, they might make their way back up again. Remember, Phoenix is doing really well as an economy, but it's gone up so fast, and it doesn't have the kind of income support that Austin does. So Austin and Phoenix are both markets that have skyrocketed, but the differentiator is Austin has more people getting salary increases, and the people coming in from California to Austin are technologists. There's a lot less of them coming to Phoenix that are technologists, so it doesn't have the income base necessarily. So when there's a correction, you could easily go down 10%.
If you own single families and want to 1031 into multifamily, does this seem like a good time to do it, or is it better to wait?
I don't think that that's changed. In general, I feel that multifamily is a good target for 1031 funds. So I don't believe that this scenario basically changes my mind on that. There's nothing in the current scenario to say, well, it's better now to 1031 into multifamily than it was a year ago. It's about the same, but still a good idea.
Okay. How does the tenant demand side and wages not keeping up with inflation affect their wallet to pay more rent? Will this create less demand?
I think so. I think rents will moderate. So I did give you guys an example, and I think I may not have pointed out that was mostly a hypothetical example. I don't actually think rents are going to go up in the US by 10% in the next 12 months. I think that as the Fed slows down the US economy, rents will slow down together with it. So we might see, 5 or 6%, growth in rents. And you might say 6% is still a lot. Yes, but inflation's at 8%. So what that essentially means is your rents on a nominal on a real basis are actually going down, not going up. So if rents go up 6% and the inflation's at 8%, well, that's not such a good thing. So I think 6% is fairly easy to achieve, but I don't think it's going to grow much faster than that. So rents went up, between 15 and 18% in the last 12 months. So they're going to moderate a great deal. You're right.
Okay, I'm kind of leaning into rents a bit. What is your prediction if there are rent controls introduced as impacting the prices in the example shown about 30 to 29 million, your example that you've created? So do you think rent control will come in?
So the answer is it really depends on where, right? So Oakland just started rent control. It's very drastic. So as you know, in past webinars, I've mentioned Oregon has rent control, but it's fairly moderate. But Oakland's basically said no more than 3% hikes. I think that's drastic. So I think any city that will create rent control that aggressive is going to see significant declines. So mark Oakland down for significant declines on the multifamily side and somewhat smaller declines on the single family side. But I currently, in the current environment, I am not seeing a lot of traction on rent control in major metro areas around the US. That might change, but I'm really not seeing much. And I personally suggest to everyone here, invest in red states. I tell people I'm a liberal Democrat that only invests in deep red states, because that way I'm safe from rent control. Rent control is a 4-letter word in Texas.
Yes. Okay. Based on all the ups and downs, when do you see the optimum time to offer grow capitis properties for sale?
Well, that really depends on which property you're talking about. But I'll give you a short answer. I really don't think I'm going to be selling much in the next 5 quarters. I'm going to wait and hold. I know this is a cycle. Remember, all of our assumptions are based on this chart here that's coming up on the screen. Everything based on this. The Fed gut punches the economy, then backs up. Never in modern history has the Fed managed to keep rates at a plateau for more than a few months, because they basically just go push as hard as they can and then they back off. They will back off this time too. I don't think this time will be any different. So I'm just going to wait until rates back off and you start seeing that downward direction, because that's when the market has more liquidity and basically all the stuff that happened in the last 18 months starts to happen again. Probably not at this level. COVID was a crazy time, but I do think that we'll certainly see some tailwinds in 5 quarters, and I'm going to just sit and wait.
Shafali says, thank you for the webinar. Do you see retrades in multifamily? Should syndicators wait to put projects under contract?
Retrades have happened. So this quarter is seeing a record number of retrades simply because what happened is, so because when the market adjusts, it doesn't just smoothly adjust, right? So what happened is, not only did interest rates go up for multifamily this last 3 months, spreads widened as well. Usually when interest rates go up, spreads narrows because lenders basically take a smaller cut. But the reverse happened. So all of a sudden we had crazy adjustments. And because of that, we've had a lot of retrades in the last quarter. I expect it'll moderate because prices will change. Remember, I am predicting multifamily prices are going to go down 5%, going to go down 10%. So people are making smaller offers today. So I think we're going to get past the retrading time frame fairly quickly. And going forward, people will basically just be forecasting based, they're going to be paying prices based on the new rates, which means the retrading becomes unnecessary. But there's a lot of it right now.
How do you see the shift from remote working to return back to the office impacting the migration patterns and household income as it relates to real estate growth?
Nothing really changes. I've been saying this for a long time. People are moving away from, the West Coast. They're moving away from the Northeast. That appears to have accelerated. I currently have found no evidence that it is reversing. So no evidence that the massive migration push that you saw during COVID is reversing in any particular way. I'm also not seeing workers return to the offices. Data suggests that less than 50% of the workers that were going to the offices are swiping their keys. Regardless of what Elon Musk wants Tesla workers to do, it seems that we are in a new time frame where people will not return to the office, which is why I made this prediction before. I'm making it again. Commercial office in the US is in a 10 to 15-year bear market. It's not in a crash because luckily they have 5 to 10-year leases.
Yes.
But they are going to be in a 10 to 15-year bear market.
Do you think the Fed will introduce a USD coin, a crypto, in the next 12 months?
No comments.
Any predictions for the Florida market?
I think Florida is doing really well. If, at the beginning of the year, you guys come to my real estate trends webinar. And if you remember, 6 out of the 7 hottest markets in the US this year were in Florida. And so in that webinar, I just said, Florida, 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 guys. And I haven't really changed my mind on that. I mean, obviously, like I mentioned Sarasota at the very beginning of this webinar when we were just chatting. I love the Sarasota market. I think it's incredible. I'm investing a lot of money, about 20, 25 miles from Sarasota. I don't think that changes. But I wouldn't be surprised if the Sarasota market drops by 10%. I mean, these markets are so red hot, right? So when it drops by 10%, don't think it's dropping. It's basically adjusting, right? It's been going up, screaming up for a long time. It's just taking a dip. I think that kind of breather is good because whenever markets don't take breathers, they always end up in bubbles, and bubbles, unfortunately, don't deflate, they burst. So I'm pretty happy that some of these crazy markets like Phoenix or Boise or Sarasota are actually going to take a breather. So I think Sarasota will do well. I think Miami will do okay. I mean, I don't know if it's going to keep going this way. It might take a little dip as well. But overall, I think Florida is in a very, very good space. Nothing I've seen from the last 3 months really changes that opinion that I had back in January.
Okay, well, let's just cap that one off by these 2 markets, which you just touched on, but 2 different questions. Why do you think Boise home prices are going to drop significantly? Same thing for Sacramento. Obviously, these people are probably invested there.
Sure. Boise is the most overvalued market in the US based on all 3 analysts that do this kind of work. CoreLogic is one that I showed you, but there are 2 others. All 3 indicate that Boise is the most overvalued market in the US. They overvalue the value of a market is estimated by looking at the home prices and comparing that to the incomes, right? So if the market is ridiculously high for the incomes, the people that live there, it's overvalued. Boise has consistently been considered the most overvalued market for the last 1.5 years now. Doesn't mean it'll drop, but the chances that it'll drop are pretty damn high. Same thing for Sacramento. Sacramento is the most overvalued market in California. It has seen astonishing price increases, much more so than San Francisco Bay Area or Los Angeles. These things can't go up forever. Again, I'm not thinking that Sacramento could crash, but you could easily see a 10% adjustment there because it's so far beyond its income.
Can you talk about your thoughts on Class A versus Class C multifamily?
Yeah, very interesting, right? So Class C was the poster child from 2014 to about 2021, right? So you've heard me many times talk about Class C being superior to Class B or Class A because I was just looking at the numbers, right? I was seeing faster rent growth on the Class C side in the 2014 to late 2020 period, right? So it was, there may be a quarter where Class A or Class B would catch up, but then C would kind of move forward again. Now the trend has shifted, right? And so I studied this. Why is it that Class C has 1/2 the rent growth of Class B and Class A in the last 12 months? So Class B and Class A was 15.3% in the last 12 months. Class B was 15.5, so both around 15.5. Well, Class C was only at 7.3%. So it's like, that's a lot of weakness. I mean, we're coming out of a recession. People have money. Why is it weak? The answer is that finally, after 7 years of very rapid rises, people living in Class C apartments are now paying 41% of their income in rent. And what we've seen is that when a market hits over 40% of incomes going towards rent, the rent increases slow down because the tenants resist it, right? There's a lot of resistance at that 40% level. And if you try and push it up, you get a lot of delinquency. So a lot of landlords become very careful because what's the point of pushing up rents and then ending up with a lot of delinquency? Delinquency means you don't get that money. So we are seeing that slowdown in Class C. Now you might say, okay, so 41% for Class C. What's that number for Class B? It's 29%. I think it can keep going up. What's that number for Class A? 24%. So there's more headroom with Class A and Class B compared to Class C. So while I've been more bullish on Class C for 7 years, I'm now bullish on the higher asset classes.
Okay, let's see. So do you see a realistic potential for stagflation?
I do. This stagflation is thrown around as like this horrible thing that nobody has any control over. But actually, if you look at the last 50 years, there's lots and lots of instances of stagflation. I mean, what is stagflation? Stagflation is simply a period of time when the economy grows slower than inflation. So economy grows at 2%, inflation is at 4%, right? That's stagflation. Now, stagflation happens a lot, but it also sort of fixes itself. And the reason it fixes itself is simply this. You have an economy growing slowly and you have inflation growing fast. Well, because the economy is getting pummeled by the inflation, the economy slows down further. Demand drops. What happens to inflation when demand drops? It drops as well because inflation is driven by demand, right? There's a few things that are not really, that are demand resistant, like food or oil. But other than that, as long if the GDP is dropping, if the economy is weakening, then inflation drops. So stagflation does tend to fix itself. The Fed worries less about stagflation in today's scenario than they do about hyperinflation.
How do you see the increased sales impacting assessed values for property taxes changing as cap rates and mortgages move over the next 12 months? It seems like property taxes are increasing because of the higher sales but this changes the affordability for single family and the OPEX for multifamily. So what are your thoughts about property taxes here?
I mean, nothing specific. Obviously, prices have gone up, property taxes will go up. And don't expect cities to cut property taxes just because the next 6 or 9 months are not as high or even going down. See, property taxes take a while to catch up, which means that even if next 6, 9, 12 months there's a recession or prices go down, don't really expect property taxes to go down. You've had fun along the ride. There's challenges with the downside, and I'm not really predicting a downside. I'm just predicting a dip.
Antoine says, amazing data presentation. He's a big fan of your work and your predictions. His question is, do you expect the tech innovation in construction and building will also cause deflation, lower interest rate, and higher real estate pricing over time? So will the imbalance in supply ever reverse?
No, not in the short term. So I used to actually be a very strong believer in the power of technology to disrupt real estate. And it is disrupting real estate. Crowdfunding, for example, is a perfect example of how real estate has been disrupted. But I have, in the last 4 months, connected to this UGrow company that, we're driving forward now. Not all of you know about it. Some of you do. Done a real deep dive on what exactly is technology doing to disrupt construction of real estate. And the answer is diddly squat, right? So there's people doing 3D printing, there's people doing modular, there's people doing, panelization, but the total volume currently is not even 1% of 1% of the US's needs. So it's, I'll tell you, maybe 2 years or 3 years from now when it's actually getting to that point. But if I had to basically look at all of these tech-driven ventures, Tesla right now sells about 1 million cars a year out of 16 million in the US, right? So people still say EVs are a small market. Now imagine Tesla's first year when they sold 40,000 cars. That's where the tech industry is when it comes to disruption. So give it a decade and ask that question again.
Let's see. So we have a question. Abby's asking does your assessment of the Boise market apply to Idaho Falls as well? He's thinking about the Idaho Falls project.
So I looked at that marketplace. So the answer is Boise, high chances of price reductions. Idaho Falls, moderate chances of price reductions. The reason for that is Idaho Falls is receiving a large number of refugees from Boise simply because they can't afford to live there. So what we saw, like for example, I am not predicting Tucson to be at risk, but I am predicting Phoenix to be at risk because people are running away from Phoenix to Tucson, right? Well, people are running away from Boise to Idaho Falls. Idaho Falls home prices are still $700, $800, $900 a month lower in rent. So it's at moderate risk, right? So I wouldn't say it's not at risk, but it's at moderate risk.
So we have a lot of market questions. So I
want to take one from Jay Scott. I don't know.
Sure.
Is this the Jay Scott?
Okay.
So it's in chat. So I think it's extremely likely that Freddie, Fannie are going to start insuring 40 and 50-year fully amortized loans, which means that we'll start seeing lower monthly payments even if rates go up. That would help the single family market considerably. So Jay, the answer is I've been hearing that for a decade, but recently one of my friends is connected to Doug Duncan, who is the guy in charge of Fannie Mae. And Doug doesn't seem to think that Fannie is really doing anything about this. I think Fannie and Freddie have no interest in doing 40-year loans. They think that that's a bad idea. Every time the politicians basically, bring it up, they kind of say, yes, we're working on it. And then they just shut up because they know that that's really a disaster for their organization in the long run because these loans are crazy. So I just haven't seen enough happen there. I think the politicians have to put more pressure on Fannie Freddie, and that could happen in the future.
So I want you to take a look at, there's a bunch of market questions here.
Sure.
I can fire them at you.
But keep going. Yeah, keep going. Let's go.
So
can we start with Texas?
They're kind of all over the place. So I'm just going to kind of go down the list and just take this as the general question. What are your thoughts about fill in the blank market? Okay. Montana.
I think it's a strong market, still benefiting from remote work. I don't expect that to stop. You should see a plateau because, boy, Montana has been going absolutely crazy. But I don't expect that market to retrace. We haven't seen any evidence that the market is at significant risk.
North Carolina.
Still very good. So, Raleigh, Charlotte, a little bubbly. They're not in any risk lists that I have seen. Probably will moderate in terms of real estate prices. I would be shocked if there was a actual real estate price decline in either one of those two markets. I don't really look at Asheville or Winston-Salem as much. I do think that Asheville is a big beneficiary of remote work, so it'll probably keep going up.
Let's see, Memphis.
Memphis is very hard to predict. I mean, because it doesn't have population growth, it's very hard to tell. I can tell you that when bad times happen, cities that have negative population growth tend to do poorly. So I'll just leave it at that. I don't quite know what's going to happen.
Let's see. What city would you tell a first-time military home buyer to buy?
Killeen.
Expand, please. Killeen, Texas.
Killeen, Texas is a market that is benefiting from the military, and there are incentive programs within that city that will basically save you a significant amount of money. I'm very convinced that that's a strong, stable market.
Okay. Let's see. Silicon Valley.
Doing okay. I have to say, so Silicon Valley is the most disappointing market in the US for rents returning to normal. As you remember, these big markets, Silicon Valley, Boston, New York, all saw big drops in rents as people moved out. So Northern California has been the slowest market in the US out of all 50 major markets for rents to return to where they are, and currently is the only market in the United States where rents are not where they were the day the pandemic struck. They are lower. So very slow recovery on the multifamily side. Single family is doing fine, doing great. I think that market is much more sensitive to interest rate hikes than other markets, right? So I do think that there's sensitivity. Having said that, I must say this: I have not seen the San Francisco Bay Area or Silicon Valley on any of these high risk charts. So not sure if it'll go down.
Okay, let's stick to California for a bit. SoCal real estate, so LA, Orange County, and Riverside area, the Inland Empire, and then also commercial real estate in Los Angeles.
I think Riverside should continue to do well. It is benefiting from remote work. I am very bearish in the long run on Los Angeles. So my wife is very tied into the Los Angeles school district because she came from LA. And so I get to hear what is actually happening to student enrollment. It is an absolute disaster, a calamity. And I think that it is going to have very significant impact on Los Angeles. I don't know if that's going to happen over the next year. I think the city of Los Angeles and the county of Los Angeles are in severe trouble.
Neal, could you put up the links to the opportunities again?
Sure, right there.
I put them in the chat, but there you go. So there you go. Got several people asking about that. Okay, what about Texas? Basically the San Antonio, Fredericksburg, Austin, and Houston.
All markets are doing well. There is no evidence that there will be price declines in any of these markets. Obviously, because I'm heavily invested in, 3 of these 4 markets, I tend to look at them. I worry about them.
Obsess about them.
I obsess about them. I really haven't seen a reason to obsess about them very much. I suppose the same thing will happen. Their home price growth will slow down. I might see a 5% dip in Austin because, boy, 50% a year, these kind of numbers are just freaking crazy, right? So I wouldn't be surprised if Austin takes a breather. I think San Antonio, Houston will do really well because they're starting from a low base and they didn't go up as fast as either Dallas or Austin. So I think that they could very easily keep going. I wouldn't be surprised if Houston home prices continued to rise and so did Austin, so did San Antonio. The other 2, I think, need to take a breather.
What about Fredericksburg?
Oh, I think those markets will do really well. I think that remote work, is again, Fredericksburg is a remote work beneficiary, but I think more than that, Texans are getting very, very rich. So when you look at markets in California like Napa, these markets are absolutely incredible, right? And I just think that Fred is beginning that ride. I think that next 10 years would be really, really good for Fredericksburg because it's basically the Napa, Valley of Texas.
Let's see, Tampa and Nashville.
I think Tampa needs to slow down. It has been absolutely on fire. I think it's too hot. It's red hot. That entire market from Tampa down to Sarasota, all the way to Cape Coral, Fort Myers, I think needs to moderate a little bit. I have not seen any Florida, any Florida city on any at-risk list, but I do think that there will be a significant, correction. When I mean correction, I don't mean prices to decline, but stabilize at least for a short while in Florida because Tampa's been extremely, extremely hot.
Okay, so moving away from our metros and locations, what are you using as a reversion cap rate on an exit for multifamily on a 3 to 5 year hold? Great question.
I think I'd be afraid of using what we've seen in the recent past because I think those cap rates were a magic time that, may not quite come again. So I would simply say, whatever you were doing 3 months ago, bump it up a quarter point. If you're especially cautious, bump it up half a point. But if you think that multifamily prices are going to increase by 1 cap, it's time for you to find something else to do.
Great. And another good question from the same person. If you are buying a multifamily property today, would you use a bridge loan or agency?
I would use a bridge loan. And I think the biggest reason for that is that I believe that I'm going to have the ability. Remember, one thing that is practically bulletproof in the way that the Fed moves is if they're going up, they will go down. Remember, 9 successive times on the screen. If they go up, they will go down. With that knowledge, How far can that be? They're raising rates now. They're raising them very fast. So they either go down in 9 months, 12 months, 15 or 18. If I have a bridge loan, it's usually 2 to 3 years. So wouldn't I have time?
We have a couple people asking, just dipping back into our projects and our locations. People are asking about the Mesa project. So the Falls at Crimson Commons, would we see lower valuations for Class A projects because of Mesa's proximity to Phoenix?
Not at all. I think that Mesa is in a wonderful place. Mesa rents are basically at this point hitting our 2026 projections. So our job in Mesa is ridiculously simple. Build it, lease it, and then either hold on to it and have lots of cash flow or sell it. So there's no evidence that Phoenix is going to crash. So if prices go down 5 or 10%, so what? Rents are already at 2026 levels. So I think we have more challenges with other projects, but Mesa is in this amazing Goldilocks zone of having achieved its rent growth before it was built.
Yeah. Peggy says you did not address Nashville.
No, I didn't. It's obviously an interesting area. It's done really, really, really well. So Nashville's interesting, right? I mean, if you think about the Tennessee economy, the state's economy is not very strong, but the Nashville economy is almost like an outlier. Tennessee's never been a fast-growing state, but Nashville is very fast-growing. It's had astonishing growth. It also has a very large amount of new construction coming in. So let's just say I'm very hesitant at this point to invest in Nashville because I want to see how much it's impacted. If it's going to be impacted the way Tennessee's been impacted in previous recessions, it's going to come down. If it truly has become an outlier city that doesn't resemble its state, then it'll do okay. So I don't know.
If there are job losses, stock market losses, moving money to the rich, do you think real estate sponsors will miss distributions and go belly up? Is holding off cash for the next 12 months a better idea?
No, I think that, so the answer, let me break your question into pieces. Will they miss distributions? Yes, for sure. Yeah. They're about to see their interest rates go up. They'll miss them, especially if you've invested in the last 12 months. Maybe if you've invested in 18 months, last 24 months, that's different because they've had that rent growth, remember? But if they just bought them 6, 7, 8 months ago, they were coming in after a lot of that rent growth happens. So they'll miss distributions. Will they go belly up? No, the market is very, very strong, and I'm not expecting it to weaken. Belly up, let me define belly up. Will some of them sell their property and you won't get your profits? Sure, that'll happen for some of them. Will they lose your money? That's very unlikely at this point.
So here's one that's related. Interesting question from Dan. How would the same amount of money invested with you in terms of returns compare a year ago versus investing a year in the future? So I guess, if somebody was investing in a project a year ago with us versus a year from now, how do you think those profits would look? What kind of returns were we offering, and what do you speculate we will be offering the market? I mean, not just us, right? Because we're,
No. And let me ask that question the way he asked it. So the answer is definitely lower, right? So obviously, if you look at this amazing phenomenon that ended when the war started in Russia, right? The 12 months before that was the most astonishing event in multifamily history, right? Markets flush with cash, interest rates at ridiculously low levels. I mean, we had this crazy Goldilocks zone. So I believe that there's no multifamily syndicator that can match what they gave you in the last 12 months in the next 12 months. The good news is the next 12 months, I'm not giving you really anything. I'm just going to sit in my properties, distribute cash flow. I'm selling nothing. So I believe that we can again time the market when the Fed starts to cut rates after a recession. And when I do that, the Fed will never again cut rates unless, something like COVID happens to what they were before. So my answer still remains, even if I do successfully time the market, the last 12 months was an outlier and cannot be repeated.
Awesome. With that, I invite you to maybe spin through the questions, take a last couple. We're just about at time. We've got 3 minutes.
So Royce asked, I thought Austin was the most overvalued. The answer is yes. A few months ago, I saw one report that it was most overvalued. I look at a aggregation of reports, Royce. And the other thing that's happening in Austin is its salaries are increasing so fast that it kind of went up to most overvalued and then back down. I'd say it's in the top 10 or top 15 in terms of most overvalued. However, most overvalued doesn't mean its prices are going to drop because it has the most momentum. Cities with high momentum can stay overvalued for a long time. Let's see, anything else? Boom, boom, boom. What about the money supply? Won't that create permanent inflation? There's no evidence so far that printing trillions of dollars anywhere in the world has created permanent inflation. So look at 50 countries that have been doing money printing. Inflation occurs and then they kind of shut it down and we move forward. Permanent inflation is very difficult to create in a world where growth is slowing. I think that's it. I think we got it all. Awesome. Well, thank you, Anna, and thank you everyone for attending. There's still 300 of you an hour and a half later. If you have more questions, feel free to email those into us. But look at these two investments. If you've got money to deploy, we feel fantastic about both of these. So check them out. And I want to wish you a very restful rest of your evening. Thank you, guys.
Awesome. Thanks, Neal. Great
Bye-bye.
presentation. Bye-bye.
Bye.